Bloomberg Markets, a wave of mortgages will be up for renewal in the coming years. And given this current interest rate environment, research suggesting homeowners could be in for quite a payment shock. Bloomberg's Christine Dobby has been digging into the research. She joins us with more. I mean, we've been hearing more and more about this, but what more can you tell us?
Yeah, so there's a new report out today from RBC, and it looks at the fact that about 60% of Canadian mortgages at the big chartered banks are set to renew in the coming 3 years. And so that's about $900 billion worth of mortgages. I think about 180 next year, 315 the year after, and then 400 billion in 2026. And with interest rates the way that they are right now, you got to remember people obviously locked into those mortgages at much lower rates. They're facing significant payment shocks, according to RBC, probably 30% more for 2025 and 2024. And then when you get to 2026, people could be facing an average of 48% higher monthly payments.
Those are big numbers, and you know we often talk about the differences between Canada and the U.S. because everybody's trying to see how do economies fare in such an aggressive rate hike cycle. There's some people, I guess, that theoretically have mortgages that are 30 years and don't have to think about, you know, every few years as you do here in Canada. So what ultimately is the view on how that's going to impact interest rate policy in this country based on what the Bay Street folks are saying right now?
Yeah, I mean, as you say, like in the U.S., people could have locked into a mortgage a couple of years ago and be sitting there for 30 years and, you know, putting some of their savings into high interest savings account right now. But in Canada, people are facing significant increase in mortgages. The 2026 year is the really interesting year because that's when a lot of these mortgages that we've been talking about as being negatively amortizing are set to renew. There are people who locked in 2021. You know, when everyone was buying, it was a bit of a frenzy, the rates were low. And the negative amortization means people are basically only paying interest on their monthly payments and the length of their mortgage is going up. And so when they go to renew, it's going to be pretty significant if those rates haven't come down by a significant amount by then. And it's not, this report says it's not really reasonable to think that the interest rate will have come down, you know, by 300 or 400 basis points, right?
Right. Yeah, no, hey, we've been hearing frequently from our Bank of Canada officials. They're not saying, don't worry, variable rate mortgage holders, we're coming to the rescue soon on that front. I guess the other part of this story is, you know, all this connective tissue. The banks that issue these mortgages, if things are getting a little rockier right now, maybe this is not the growth market it once was for them, which I guess leads into, you know, you cover these banks, and what do we know about what their own performance is going to look like in the coming years?
Yeah, that's why this analyst actually wrote this report. He was looking at what the outlook is for the Canadian banks' retail businesses, and he does see pretty slow growth at the retail banks of 3 to 4% over the next few years, and that's obviously because of this mortgage issue. And it's going to have knock-on effects, right? As people try to save the money that they have to make those mortgage payments, they're not going to eat out as much. They're going to perhaps default on their credit cards or their auto loans. So there's credit losses that the banks could be facing as well. You know, he's not saying this is going to be a wipeout for the banks, but it's going to be a tougher environment for sure.
And I guess in terms of the other factors to be watching with the banks themselves, it doesn't feel like so far we've heard them saying too much about just to be. And look, there are a lot of safety nets within our housing market, within our mortgage market as well. But the banks themselves, when they're concerned about the outlook for all of their portfolios, they'll set aside certain amounts of money, and then they take a financial hit on that in the short term. So I guess we have to sort of keep our ear. We're getting closer to bank earnings season, and maybe we have to start listening a little bit more for what they're saying, whether it's on the mortgage side or their entire loan portfolio. Yeah,
I think that it would be interesting to see how they approach mortgages and credit loss provisions for credit losses in this next quarter. I think, and you guys have been talking about this a lot as well, that commercial real estate is probably the area where they're going to be looking at more provisions for credit losses, but this is a developing issue for sure.
Okay.